Hello, everybody, and welcome to this week's podcast for the week of February 11th, 2026. I'm joined here by David Clark. How you doing, my friend?
Doing well. I'm finally thawing out,
Yeah,
as
nice
I
to
think
have you
is the
back
rest
in.
of the East Coast.
Yes, nice to have you back in Richmond. We're actually getting the past couple days worth of weather has been up in the 50s and 60s, and like you said, I'm still tripping on ice as I walk into work and everything like that. But yeah, like you said, we're getting a little bit warmer. Other things going on. You have any big Valentine's Day plans? That's coming up.
Not in particular for us. My wife and I are kind of sans doing a lot of Valentine's Day
Lucky
plans.
man.
But yeah, I lucked out. I know many are going to think that. They're going to be like, how did he manage that? To be honest, she dictated that. So
Right.
I'm like, I mean, I'm not going to argue, right?
Right. Yeah, why not? Well, around the office when we talk about love, we love point figure charting. That's just an awful transition, but we're going to look past it. The last week's worth of action, relatively positive for a couple of areas that you wouldn't really expect when you look at, the last year or so. You've seen positive movement from the average S&P 500 stock, the equal weighted index. You've seen it from the Dow Jones, gold, and precious metals. Those seem like a roulette spin, essentially,
Especially the
whether they're
past
up or
few
down.
weeks.
Yeah.
Yeah.
Um, but towards the downside, some of your more growth focused areas, the Nasdaq Composite and Nasdaq 100, the cap weighted S&P 500, those guys towards the negative aspect, at least for the last 1 week roll. So there's a lot of stuff to talk about today.
Yeah. Well, and with like starting on some of those indices that we've seen lead the way to the upside, especially for the S&P equal weight and the Dow, we're not only seeing returns to buy signals towards the end of last week for those indices, but this week we're getting fresh new all-time highs.
Right.
So I believe for the S&P equal weight, it was over 8,100 or 8,150. The Dow crosses the $50,000 mark or 50,000 point mark
Yep.
rather for the first time in its history. And you brought up this study, which I remember doing this study back when I started, and it used to be such a big deal when the
Hmm.
Dow would rally 1,000
Yep.
points and hit a new record, and we would all be excited to update this table.
Right.
It's a slightly different perspective
Yeah, I
now.
was I was writing the feature this morning and I was like, what am I going to write about? And I was doing the morning video and I said, oh man, it just hit 50,000 last week and I don't think we wrote about it. It's like, when was the last time that we did that? And it was at like 37,000 at the end of, 2023 or something like
Mhm.
that. I was like, dang, it's really been a while. And the reason for that is 1,000 points out of 50,000 is a 2% move,
Right,
right? Which could literally happen in an afternoon, depending on who's tweeting, right?
right.
So, it's a less notable move, but 50,000, right, at like a midlife crisis for the Dow, yeah, that's a pretty big point,
I
right?
mean, in kind of a hilarious unintentional pun in some fashion, because it's kind of getting to this point where we're seeing at least a couple of the indices move to new highs, most indices at least continuing to move higher. Um, we've had some improvement from like the Russell 2000 returning to a buy signal. And even though there's maintaining buy signals, there's a couple that have sells. But generally speaking, it's sort of positive, but it's been one of those interesting starts to a year that while it's been so positive, it's sort of like there is still this cautionary feeling
Right.
that just feels in the air.
Well, a lot of that is stemming from weakness in technology, which we'll talk about more in just a moment. But while we're still on the topic of the Dow, we'll throw up, if we haven't already, that table that we're referencing,
Mhm.
looking at different breakpoints. Now, for this specific table, what I did for the research today was I went through and knocked out. So we're not looking at every 1,000 point break. I did my best to keep them so we're at least past 10,000, we're looking at breakpoints of around 5 to 10%. So just a little bit more of apples to apples comparison. And on average, we'll break through from 10,000 to 50,000. We've moved to a new breakpoint. I think it was once every 450 days on average,
Mhm.
give or take some. Now, obviously, there's some big numbers in there,
Yeah.
but the last instance going from 47,000 to 50,000, only 105 days.
Well, and that was the thing I was getting ready to say, even to your point of saying that average around 450 days. What's interesting to me is even when you're trying to normalize it in that almost 5% performance span or or range, if you will,
Yeah.
you still end up seeing these interesting moments where it's 100, just over 100 days or 150 days,
Right.
100 and some days, still suggesting to you that even though we're not saying it's, 1,000 points and it's 5%, it's still accelerating in that 5% in a short amount of time. That
Right.
was a long-winded way to really get to that point of basically saying that even when we're getting these rallies at higher at point levels or price levels, we're still seeing these accelerations to new highs, in fairly short order in quite a few cases.
Well, that's a post-COVID world, and we can look at
Mhm.
that, the statistic, the 400 something days I just said. If you go from 40 to 50,000 and just focus on the four breakpoints in between 40 and 50, you're at somewhere like, like 170 days.
It took you a year and a half to go from 40 to 50,000,
Right. Yeah. I
honestly.
remember,
So
I think we were out at like a Dorsey Wright golf event on the day or something like that. We were all getting together, the group of analysts, and I think we
I
were,
still remember when the Dow hit 25,000 and it
yeah.
was like, oh, that's high. I even remember, and this is just me showing my age and I guess my time being at Dorsey Wright, is I remember Ralph Acampora talking about a painting he had on his barn of the Dow Jones Industrial Average. And once it hit 20, it was either 21,000 or 23,000. The barn was gone. Like he
Right.
had
He
nowhere else to go
got to
above
build
that.
another one.
And now I'm like, does he have a second
Does
floor
he
on the
have a second floor?
barn?
Oh, Jesus. But yeah, I mean, it just like I said, it goes to speak about how quickly markets are moving, and a lot of it is spurred on by really quick changes in relative strength on the asset class front and on the sector front as well. Domestically, we were watching in preparation for this, Joseph and Ian talking last week's podcast. Great job, guys. If you haven't watched it, certainly go do. But we'll throw up the rankings specifically. They took a look at the broad asset rankings with international equities moving into one. But there's been a lot of movement underneath the hood when it comes to the domestic equity rankings. So we want to focus on that specifically just for a few minutes because we have seen a lot of rotation. Industrials, a sector I cover, I'll
Yep.
throw out there, is up there in the first position, dethroning the likes of comm services, dethroning the likes of technology, some other growth focused areas, and in its place, industrials, basic materials with precious metals doing quite well, right? Those are the guys now at the top when technology and comm services have been leaders for so long.
Yeah, and we've seen some of the rotation begin within some of our models too. But I mean, even what we've seen reflected here in Dolly in terms of that sector rotation has sort of been confirmation of what we've seen building in other places.
Right.
The fact that we've seen that breakdown in tech, especially just the sort of tech AI theme really being where we've seen a lot of that downside impacting communication services and technology. But you have these stalwarts like your industrials, basic materials, and then energy having been the big improvers
Yep.
for really the last 6 to probably 9 months. So, I mean, in some fashion, some of these stories aren't brand new. It's just confirmation that we're seeing the long-term relative strength now impacted in a very material way.
Right. And you're talking about some of these groups that have been really long outstanding points of weakness. Energy, crude is getting a little bit of a bid up and everything like
Mhm.
that. Energy is moving up higher in the rankings. Precious metals and all that kind of filtering through into basic materials, which were towards the bottom half for quite a while. Healthcare is one that you didn't mention, but there's
Yeah.
specific strength from biotech, which some of our models have picked up
Mhm.
specifically. So there's a lot of these areas that are starting to take away some strength from the core of the market. And building on that idea, we've got another piece of research that we had put out into the report recently, which took a look at the sector strength and how many sectors are kind of beating the market, if you will. So if you go, do you have that other one pulled up, the one from Focus 5?
Yep.
Essentially this one is just a metric of, okay, if we look back over time, which how many sectors of the market are actually outperforming the market,
Mhm.
right? And what we've seen, if you focus on the right side of that chart, is it's been as we all know, a very narrow market environment, right?
Mhm.
Tech and comm services are the only ones that are doing it. And if you're not in those sectors,
Or at
sorry.
least not very overweight them. Yeah,
Yeah,
you're looking at a pretty awkward
and
portfolio.
and what we've seen in 2026 has been a rotation away from those groups in preference of other areas. Now it's not just tech, it's not just two sectors that are outperforming the market. There's, quote, the market being SPY essentially.
Mhm.
But point is that there's now a handful of sectors that are doing better. It's just not tech anymore, right? And so what that leads to is a more productive environment for rotation, right? Where there's dispersion
Mhm.
between the market and what's doing well. Momentum is able to take advantage of that. We've seen that in some of our models.
Yeah, and Focus 5 is the one that you keep bringing up, and it's had to close out 2025 and moving into 26, a pretty quick succession in or rotation rather of how it's gone from a very tech oriented focus to, granted, it did add semis in November, but that is sustained at least somewhat better from a technical perspective than other areas of
Right.
tech. And then from there, it picked up aerospace and defense, our industrials that we've been talking about. And then, as you mentioned earlier, it's one of the strategies that in January picked up biotech exposure, which last time it had biotech exposure was from 2018 to 2019.
Right.
And then there was a period I remember back from like 2014 to 2016 where biotech was the jam.
Right.
I think that's where you wanted to be.
Right.
So to your point, seeing a lot of this rotation having already taken place within some of the strategies, namely in this case, the Focus Five is the one we're talking about the most. But I mean, there's a variety of sector rotation models that have seen similar adaptations.
Right. And, we'll obviously we look at the models, we're, honing in models, we're talking about models with clients, things like that. But there are certainly signs that it's not just happening inside the models page, it's also happening on other broad asset level investing tools we've got, like the asset class group scores
Mhm.
page. Now, for those that are unfamiliar, what the asset class group scores page does is it takes 134 different groups and then it organizes or categorizes all of the mutual funds and ETFs listed on the platform into one of those groups, and then simply just ranks them from top to bottom based on their average score. So, said more plainly, your strongest groups are at the top, your weakest groups are at the bottom. There's a couple of really important ones in there: cash, commodities, fixed income. The S&P 500 index funds group is also one that we'll reference quite often, and which we'll typically look at, say, hey, where is the average S&P 500 index fund sitting in comparison to all those groups? If it's at the top, that means that the core is very strong. If it's at
Mhm.
the bottom, that means the core is very weak. And we'll typically refer to a percentile. So if we're in the 100th percentile, we're at the top. The 0th percentile, we're at the bottom. And what we've seen is that percentile slowly drop off. We've seen it drop from around 95. I think it got up to as
Mhm.
as as, as high as 97, 98%, earlier in 2025. And it's since dropped off to around a reading of 87%. So still very strong, but there's other stuff doing better, right?
Right. And I mean, for those who, again, are sort of familiarizing themselves with that core percentile rank, to your point, especially even for the past 5 to even 10 years, you've consistently seen that core percentile rank have be a 90th percentile or above.
Right.
And in many cases, especially in the past couple of years, it wasn't uncommon to see that core percentile rank group in, the 97th, 98th percentile ranking as the number two group out of 134. So I
Right.
mean, your ability to then say, what am I looking to outperform the market is
Yeah.
literally just one or two
2x
groups.
market, right? That's right.
I mean, and
Yeah.
that's the thing. That's when you're in an environment that you're like, all right, I guess I'm just going to join the market and see how I can leverage it.
Right.
But now we're getting into an environment, and in some ways, we sort of saw this beginning in the back half of 2025. It's just materializing more now
Yep.
as we begin 26. And while most of the groups that we look at right now that rank above that S&P 500 index funds group are international equities. We won't try to belabor that too much because last week's podcast talked about quite a
Yep.
bit of the international equities. It is a different lineup of sectors, though.
Right.
And that's where we see our industrials coming into play again as well. Transportation's also up there, kind of a flare of industrials
Right.
that you're seeing rank higher. Biotech being another group. Precious metals, kind of an interesting group because it's a bit of a sector and commodity group as
Right.
well. But point being, you're getting this broadening or at least more options to look at that say, okay, that really is and has shown a better trend and technical picture than the broader US equity market right now. I've got somewhere else to look.
Right. And if you're a money manager listening, this is your Super Bowl, right? Because for the last couple of years, we have, like you said before, if you are outside of the S&P 500, which is our benchmark, by the
Mhm.
way, if you're outside of it, tough luck, right? Now there is at least some cause for, hey, we can actually go out and pick stocks within transportation. We can actually go pick up some commodities exposure, some international exposure, and add some flavor into our portfolio that isn't just owning the benchmark, right? While the benchmark remains strong, I don't want anyone to get the wrong
Yeah, you're not
message,
getting
right?
away from it.
Right. Don't go out and get rid
You're
of
not
your
getting away
core.
from it. I mean, it is
But
it is
there's
there to
space.
stay.
There's space there, I think is the point that we're trying to make. That is simply saying, hey, there are other groups that you could look towards instead of it just being so benchmark and core driven. Speaking of benchmark, as we wrap up the podcast, very much of the benchmark is going to be tech focused. Now, technology in general, of course, has got a lot of subsectors in there. There's semis, there's software, there's hardware. Speaking specifically about software, which has been a point of weakness, what we'll do for our last chart is throw up the chart for just a general software
ETF.
ETF, excuse me, and notice how weak it's gotten, right? You look at the default chart, we've seen a string of three consecutive sell signals, getting a reversal back down lower with intraday action on the 11th, and now within striking distance of those 2026 lows. So obviously, we've seen material deterioration here, I think is definitely worth watching.
Well, what's interesting in terms of the rebound that we sort of got off of oversold territory, and this can be somewhat of a lesson to folks in terms of looking at chart mechanics, and this is obviously with hindsight, but it's just intriguing to see something work out this way. When we did see that rally, we basically got a rally right to the bottom of the trading band, and then it failed,
Right.
and we're reversing down. So, I mean, even though those bands are on there just kind of over time, and they're sort of seemingly like you know they're arbitrary, they
Right.
have meaning in some fashion. That and I think it's interesting that whenever we saw that rally, that's where we got rejected, is at the bottom of that 10-week trading band for IGV. And ultimately now with today's action, we're reversing down, going back to test those lows right around 80. And in truth, if we move down into that upper 70s or even below into the mid 70s or lower 70s, we're looking at levels we haven't seen since 2023, which is about really when a lot of this rally started.
Right.
So, you know, for a lot of for some of this broad tech exposure here that we've seen, it's not like it's too far from revisiting where it sort of began. You
Oh
know,
yeah.
much of the bullishness that we've seen over the past couple of years.
And listen, there's somebody listening at home who is saying, David Miles, you're going to tell us now it's reversing. Well, what were the signs before, right? And if you look at the chart, right, you'll notice those highs in 2025, and then you'll notice a cascading level of sell signal, lower high, sell signal, lower high, sell signal, negative trend break, right? So as you're looking there, of course, hindsight is 2020, so we can point those out. But where you see a petering of demand, right?
Mhm.
Thinking back to that supply and demand game that we're playing, where you see a petering of demand off of those highs, that is, meanwhile, we're breaking through support. That is a sign that sellers are in control. Bulls cannot get us back up to those highs
Mhm.
that are so important. And ultimately, then that just culminates in you breaking into a negative trend and kind of falling out of bed from that point. So obviously, this has been an area that's dragging down technology in general. That's been a catalyst for a lot of the weakness we've seen from the sector. And until we see material improvement from this group, it's going to continue to kind of be a major headwind for technology.
Well, and to your point, looking at some of these charts, I mean, this is where the art part of it comes in. But if someone's trying to look for general rules of thumb, to your point, seeing a breakdown along with series of lower tops, I mean, is the definitive definition of supply taking control,
Right.
losing demand. And in many cases, to me, you can get one or two sell signals through something like an earnings season bout or
Right.
whatever it is, and you can get a sell signal in a strong uptrend. But once you tend to get that third sell signal, it's not like that's a magical number, but even in this example, that's when you saw the material breakdown happen
Right.
further, you know, really give way in terms of the breakdown occurring. So, in some fashion, you know, if you're seeing positions give consecutive sell signals already, that's your sign.
Right.
You know, it's not like it's telling you that there's a magical number here. No, it's already giving you the sign. If you've seen consecutive sell signals, And then if you're beginning to also see additional levels of support violated, looking like another sell signal might materialize, again, you're already building the evidence yourself without even realizing it.
Right. And momentum is self-correcting. So ultimately, right, if this conversation, if
Mhm.
we see a reversal, right, momentum will ultimately, the technical score will improve, we'll post
Hand
buy
up, it'll
signals.
say my bad.
Right. And it will go there and you'll see that kind of filter through the rankings. Just right now we have to cover up the name of the chart. We got to look at what it's showing
Mhm.
us. And right now the path of least resistance continues to be lower for the space. Obviously a lot of stuff going on. Obviously a lot of things that we're going to want to watch as we move into, through February and into March and wrap up Q1. What do you say we call it here and move on?
Yes, there will be plenty more to converse about in the coming weeks, I'm sure.
Yes, sir. Well, listen, we appreciate you all. Have a wonderful week. To all you lovebirds, have a happy Valentine's Day, and we'll catch you again next week.